Good morning and welcome to NYSE TV Live. I'm Trinity Chavez and today is Thursday, June 6th, and we are coming to you from high above our trading floor at the New York Stock Exchange. And in just about a half an hour, Moody's, which trades here at the NYSE under ticker symbol MCO, will celebrate the relaunching of its brand earlier this year by ringing the opening bell. Now, Rob Fauber, the company's president and CEO, will do the honors and open up the U.S. equity markets. And for those of you who might not know, Moody is a global risk assessment firm that aims to empower organizations to make better decisions. Now, the company's data, analytical solutions, and insights are designed to help decision makers identify opportunities and manage the risks of doing business with others. One thing Moody's known for is its credit rating system. The company's team of analysts scattered across the world evaluate the financial health, management practices, industry trends, and economic conditions surrounding non-financial corporations. Well, actually, corporates. Financial institutions, structured finance vehicles, protect finance vehicles, and public sector entities. After Moody's completes its research, it assigns a credit rating that indicates the likelihood of default or failure to meet financial obligations. And just like in school, getting a grade in the A range is the best company rating a company could get. Companies rated a single A, double A, or the highest possible score of AAA signal low to minimal risk. Now, moving down the scale, entities with a grade of B or AA present moderate credit risk, while receiving just a B grade are considered speculative and are subject to high credit risk. A grade in the C range are judged to be poor in standing. Now, entities with the low possible grade C are typically in default with little prospect for recovery of principal and interest. Now, the company swept headlines in the U.S. this past fall. In November, Moody's lowered its outlook on the United States credit rating from stable to negative amid the political impasse around the debt ceiling. Moody's said in a statement, quote, "Continued political polarization with U.S. Congress raises the risk of successive governments will not be able to reach consensus on a fiscal plan to slow the decline in debt affordability." Now, it's worth noting that despite the negative outlook, Moody's still rates the U.S.'s long-term local and foreign currency country ceilings at the highest possible rating of, well, AAA. Now, if Moody's were to continue or change the United States rating, it could result in the federal government being unable to borrow as much money or having to accept a less desirable interest rate. The consequences stretch from difficulty paying government workers to struggling to provide services like Social Security. Switching gears a little bit now, Moody's coverage extends across a wide range of industries and sectors, including ESG. Now, when GE Vernova listed here at the NYSE earlier this spring and began trading under the ticker symbol GEV, Judy Shaw spoke with Roger Martella, the company's chief sustainability officer, to discuss its unique sustainability framework, the acceleration of the energy transition, and how stakeholders influence sustainability outcomes for GE Vernova. Let's take a look.
Well, over the last 24 months, we really wanted to step back and build the leading company for the energy transition. So we said we also want to build the leading framework for the modern era. We don't want to just take anything for granted. So we started over on a blank piece of paper. And what we really focused on before we even put anything down were a few principles. We wanted to focus on impact. We can't be all things to all people. Our impact in the world is electrifying the planet, it's decarbonizing the energy sector. So we're going to focus on those core impacts. We also wanted to be pragmatic. We have to succeed first as a business if we're going to succeed for our sustainability goals. We're unapologetic about that. So we're really focused on business success, and my job is to align what we need to do as a business and how do we translate that into that broader public good where we're solving for climate change, electrification. And the third principle was credibility. We want to make sure we're speaking beyond reproach, that we're not using emotional language, and that we're being a bit of an honest broker in educating. That also means when we see things going well, we're going to share that. When we see things not going well, in the spirit of continuous improvement, we're going to be transparent as well. So these themes of impact, pragmatism, and credibility have really guided our approach in what we think is a leading modern era sustainability framework.
Now, we're really seeing an acceleration in the energy transition. What's driving that?
You're absolutely right. And as a company that had something to do with the first energy revolution back to Thomas Edison, we're also seeing the leadership in the current, what we're calling a super cycle of the energy transition. And it's almost aligned to the last 24 months of us building GE Vernova. It's a number of factors. One thing is, the very tragic war in Ukraine, which has really woken up the whole planet. We're very proud of our support for Ukraine to keep the lights on. but it's really woken up the whole planet to say we can't take the grid for granted. How do we invest? How do we accelerate energy security, electrification? And then you have the growing demand generally. The IEA predicting a doubling of electrification demand from 2020 to 2040 because as other sectors decarbonize, they're joining the grid and electrifying. We're focused on energy security at the same time and resiliency. And of course, a hot topic here on the stock exchange, data centers, artificial intelligence, American competitiveness, and the additional demand drivers there. So we believe we're at the beginning of this energy transition super cycle. It's good for electrification, it's good for providing affordable, reliable, sustainable electricity to everybody. And as we do that, we're going to decarbonize the grid at the same time through innovation and technology.
And what are the focus areas in your technology pipeline? What are you investing in?
So we help produce 30% of the world's energy. And so we really have two views on how we decarbonize the grid while we're increasing capacity at the same time. The first is we're focused on this decade and the technologies that are kind of our core technologies today. Growing renewables as quickly as possible, making sure that we're supporting very reliable and efficient gas turbines all around the world, which can be decarbonized over time. Nuclear power, and then just physically enhancing the grid, making it more resilient through transformers, high voltage direct current, and software that can orchestrate the grid and the electrons at better time and make the grid more secure. So that's this decade, and that's going to help us drive a lot of progress. But we know it's not enough to get fully to our goals. So we're in our labs, we're in our researches, innovating the breakthrough technologies of tomorrow. So small modular nuclear reactors, we have the leading product there, the first to be commercialized. Using hydrogen as a fuel in our turbines, and carbon capture, sequestration, and direct air capture. And what's really exciting about these breakthrough technologies, while most of them come online next decade, as we're moving through this decade, they're becoming more and more real, and they're moving out of the labs, out of the research centers, into the field, into pilot projects. So we're starting to see, thanks to some good public policy as well, these ideas become reality.
Brian Matt, Director and Head of ESG Advisory here at the NYSE, is joining me now to dive into this topic a little bit more. Good morning and welcome to the show.
Morning, Trinity.
It's great to have you. So let's talk about how you're fresh off the plane. You just came back. We were just talking how you literally just came from Toronto.
Back and forth from Toronto. World Federation of Exchanges has its sustainability leaders from all the global exchanges, as well as investors and other leaders get together once a year and talk about, honestly, harmonization of all the different things that we're doing from a sustainability perspective. Making sure that companies don't have to follow 10 different standards, but hopefully follow one standard for the things that they're doing, the things that they're reporting on, and how they talk to investors. So it was great to have that group together all in one place in Toronto, and hopefully be able to push for that type of evaluation going down the road.
Let's lean into this more. Let's talk more about exactly what ICE is doing when it comes to the sustainability sector. Inform our viewers who might not know.
Sure. So ICE runs a sustainable finance unit, as well as really the world's largest environmental markets unit. So when I think of sustainable finance, I think of investors need to look at the ESG risks in their portfolio. They need to look at the climate risks in their portfolio. That climate risk can be either transition risk over the long term. What does your company look like as we transition to a lower carbon economy? Also physical risks. Are there risks of wildfires, of hurricanes, of floods to the physical assets in those portfolios? Then separately, ICE is one of the largest providers out there in the future space in environmental markets when it comes to identifying what is an effective price on carbon in different markets based on carbon allowances or carbon credits, as well as pricing renewable energy out there. So that's two different pieces that ICE is doing today to help the investment community.
Let's lean into this topic a little bit more. Also, investors, from an investor standpoint, what should they be on the lookout for? What are the biggest trends that they are making headlines, when it comes to the sustainability space?
Yeah, I'd say this year it's been all about climate. We've had a lot of discussions around starting to look at the climate risk within your portfolio, especially across different asset classes. So the companies I work with at NYSE are now more increasingly interested in publishing their carbon footprints, setting their targets, and being able to match to their goals over the long term to decarbonize their businesses. Then as asset managers looking to invest in those businesses, you have to be able to see across your entire portfolio, what does your carbon footprint look across all of your asset classes, and be able to make the decisions you need over the long term to meet potentially an investor's needs, an outside asset owner that has asked you to build them a lower carbon portfolio. So that's what's underway this year.
Amazing, a lot to look out for, and we look forward to having you back on the show to talk more about all of your initiatives.
Excellent, thank you.
It's great to have you. Now we'll be back in just a moment as Moody gets ready to ring the opening bell, officially opening up the U.S. equity markets. But first, here is one tool investors can use to identify and report climate factors in their portfolios.
Climate events are rising in frequency and severity. Increasingly, climate risk impacts investment risk. To help integrate these risks, the ICE Climate Transition Analytics tool generates analytics to identify, assess, and report climate factors in portfolios and loan books. Upload a portfolio to generate an array of climate analytics. Access carbon footprinting analysis, avoided emissions data, and Scope 3 emissions data. Conduct net zero analysis. Compare portfolio and benchmark pathways. Check portfolio's progress towards stated decarbonization targets. Conduct scenario alignment. Analyze portfolio implied temperature rise score and assess trajectory against chosen climate scenarios. Calculate temperature scores using the Science-Based Targets Initiative aligned approach. Access stranded assets data and analyze fossil fuel reserves footprint and country-level exposure. Generate and customize powerful reports, including TCFD-aligned reports that can help you meet your regulatory and stakeholder requirements. Access ICE's Climate Transition Analytics and more today.
Now, a very busy one-week span of economic data kicked off yesterday when May's ADP private payroll reports came out, and the data showed that private employers added 152,000 jobs in May, well below the 175,000 economists pulled by the Dow Jones that they were expecting. Part of the lower total came from small businesses. According to ADP, May was the challenging month for small firms, losing 36,000 jobs among firms consisting between 20 and 49 people. On a recent Inside the Ice House podcast, Amos Winbush, the third CEO of Backers, which enables, which enables small and medium-sized businesses to raise growth capital to help bridge the gap between lenders and millions of small and medium businesses, explains why we're seeing this portion of the economy struggle. Let's take a listen.
SMBs are struggling. That struggle often isn't seen because we just go about the business of getting it done. I think also SMBs are really hesitant to share that they need help. So destigmatizing that is really important, and allowing small and medium businesses to raise capital with dignity is key. When you look at access to capital, it has to be a decentralized approach because the problem is just so big. There are not enough players to issue out cash, to deploy cash. And I think when you look at small and medium businesses as a whole, and even if you take what President Biden said and you drill it down to the numbers, half of the U.S. workers represents 62 million people.
And make sure to listen, review, and subscribe to Inside the Ice House podcast on your favorite podcast platform. Join Josh King every Monday for conversations with leaders, entrepreneurs, and visionaries, and scan the QR code here to listen to the most recent episodes. And as we mentioned earlier, investors will be paying close attention to the economy over the next week. This Friday, the Bureau of Labor Statistics releases the May jobs report, and according to data from Bloomberg, the report is expected to show 185,000 jobs were added to the U.S. economy in May, with unemployment holding steady at 3.9%. Now, things will come to a head next week also on Wednesday with a 1-2 punch of fresh data. Now, before markets open, the Bureau of Labor Statistics will release the Consumer Price Index for May, and investors are hoping to see the annual rate of inflation continue to cool. In April, overall consumer prices rose 3.4% from a year earlier, down from 3.5% in March. Now, excluding food and energy, core inflation growth was at 3.6% compared to the year before, the lowest reading ex-food and energy since April 2021. Then at 2 p.m. Eastern on Wednesday, the Federal Reserve will announce its latest policy decision on interest rates. According to the CME Fed Watch tool, it's a near certainty that that rates will remain unchanged between the 5.25% and 5.5%, as it has been the case since July of 2023. But as Freedom Capital Markets Chief Global Strategist Jay Woods, who's going to be joining us later on in the broadcast, has told us previously on the show that investors will be closely listening to the Fed Chair Jerome Powell as Jerome Powell comments regarding a timeline for rate cuts later on in the year. Now, moving on, I was recently in San Francisco at NYSE Pacific offices covering RSA, one of the world's largest cybersecurity events in the world, like I said, and speaking to some of the biggest industry leaders about the biggest challenges and trends that we are seeing in the cybersecurity sector. Now, one of those leaders is Proofpoint CEO Samit Dahan, who told me about how his company is protecting organizations and their people from targeted cyber attacks. Let's take a look.
Protecting companies' information and protecting people against targeted attacks. That's what Proofpoint does.
How do you balance user privacy with effective cybersecurity?
If you think about it, most of this protection has to happen with sophisticated data and models that work on the data, because these attacks are not simple spam. These are very targeted attacks, or you're studying user behavior. The technology that we have built is leveraging the power of the data, but fully anonymized. So it never works on a single customer or a single user information that's exposed to anyone in the models. It's fully anonymized and ensuring that you're using the best of the data, but applying the appropriate anonymization techniques so that all the privacy controls are in place.
How is Proofpoint really integrating AI and leveraging that technology to be able to navigate the complexities of the current landscape?
In this new world of work style, where all our data is everywhere, we all are everywhere where we are working, and as a result, you do need to rethink how you have to do your data protection. Okay, so the world of data security has fundamentally changed. What we do in applying AI is we do it in two ways. Firstly, we apply AI to fight against AI. Over the course of last 12 to 18 months, partly because of the emergence of Gen AI and crypto, there have been 20x increase in attacks against people for phishing credentials.
Wow.
20x. Okay, so clearly you need AI models to fight against them. So we build AI models to ensure that those targeted attacks are protected and prevented by using AI.
But the bad actors also have access to this sophisticated technology, this sophisticated AI and Gen AI. So how do you stay ahead of them, knowing that they have access to this as well?
Any of us can create a fairly simple or too sophisticated attack and start doing our own phishing campaign against any of the targeted users. So the way our technology works is it's always assessing what's normal behavior. What's normal communication? We build a behavior graph, if you may, our technology. How is a user, who does Trinity communicate with usually, and what type of information is communicated? So our behavior graph actually protects you from both inbound threats, which are caused by the bad actors, as well as potential data leakage.
Well, thank you so much for joining me today.
Thank you, Trinity, for having me.
I also spoke with SailPoint CEO Mark McLean, who told me about identity security and the company's AI methodology of proceeding with caution aggressively. Check it out.
We focus on an area called identity security, which is really ensuring people have the right access to the right data and systems.
Obviously, identity-based attacks are becoming more and more prevalent in today's society. Is that driving SailPoint's growth at all?
It's very clear that the demand for solutions in this realm of security is only increasing. We hear it from customers of all sizes and scales. We're pretty global, we operate around the world, and it's a common refrain. Absolutely, our ability to capture that growth and that demand is absolutely helping drive healthy growth for the business. AI is at the forefront of so many discussions around the world, generative AI, the rapid development of technology. And we're seeing more and more companies, corporations really move to SaaS applications, move to the cloud. How are you ensuring data privacy as well as integrating AI, but still staying ahead of the bad actors? Like at the end of the day, there is clearly a positive and negative aspect to what's happening with AI, right? And on the one hand, we believe, as do most of our compadres in the security industry that we're going to be able to do some of what we do better and more effectively. Unfortunately, so will the bad guys.
Yeah.
Right? And so there's a little bit of a cat and mouse going on with how do we use some of these emerging technologies to better understand threats or potential compromises, all the stuff we just talked about, while they, on the other side, are using those things, whether nation states or criminal actors or others, to try to compromise our organizations. I love this term. I still don't know if I fully understand it, that these tools occasionally hallucinate. It literally means it makes things up as it's building these inferences from its models. So we can't have things where the system thought something was true that wasn't and then act on that. And what we do, we have to say, look, we still may need some validation of what the tool is telling us. We're proceeding with some caution. We joked about our phrase is proceed aggressively with caution as it comes to AI, right? Lean in, figure out how to leverage this technology, but don't go all in a way that could potentially expose us or our customers.
What are some other big themes this year at RSA?
But increasingly, identity is a relatively newer thought process for a lot of security professionals. How am I controlling? I say sometimes what we really do is control security through the lens of identity.
Yeah.
People have controlled security through the lens of the network, of the device or endpoint, of the database. It's a newer thought to say, do I really understand my identity landscape in my organization? And am I controlling and protecting my enterprise through that lens?
Thank you for joining me today.
Thanks, Trinity.
And last month, the epicenter of global financial markets here at the NYSE officially turned 232 years old. And since its inception in 1792, the exchange has grown to include over 2,400 listed companies and accounting for roughly $40 trillion in total market cap. And the exchange has become synonymous with corporate giants and hosts some of the most recognizable names, including Coca-Cola, IBM, and Disney, offering investors the opportunity to invest in well-established, trusted companies. But there's so much more to the exchange than its listed companies. NYSE curator Anna Mello takes a closer look at the exchange's history. Let's take a look.
This year, the New York Stock Exchange is celebrating our 232nd anniversary on May 17th. The history of the exchange has always been a history of technological disruption. As capital is raised, shares are traded, and information is disseminated with the public, it is always using the most advanced technology of the time for over 2 centuries. When the New York Stock Exchange was founded in 1792, trading looked far different than it does today. We operated as a call market, which looked a lot like an auction. The president of the exchange would stand at the front of a room and he would call the name of individual securities to be traded in increments of 5 minutes each. Asking price, actual price, and final price were all recorded in a quotation book just like this one, dating from 1819. The stock ticker, the first market-specific invention and arguably the technology most closely associated with the markets, was introduced to the New York Stock Exchange in 1867. Up until the 1990s, when traders adopted the internet, stock tickers provided vital market information to businesses and news organizations. A stock ticker is essentially a specialized telegraph that prints an alphanumeric symbol onto a piece of ticker tape, alongside the current price of a company's stock. This particular example is one of the earliest stock tickers used at the New York Stock Exchange, dating from 1880. It was able to print 250 characters a minute. The New York Stock Exchange nickname of the Big Board derives from our original broker paging system, the Annunciator Board, installed in this building in 1903. Each of these Annunciator numbers was painted with an individual member's broker number and arranged on either side of the trading floor in racks 800 square feet each. With the press of a button, one of these flaps could be flipped over, alerting a broker on the floor to the fact that he had an order waiting with his clerk. These were eventually replaced by an electronic paging system. The original high-speed data network of the New York Stock Exchange was installed in our current building in 1903, a pneumatic tube system that sent trade tickets all around the exchange. Executed trades were written or typed out onto a slip of paper and then inserted into this tube called a widget. The widget was then placed inside one of these terminals, each labeled with its destination, and then a puff of compressed air from the compressor down in the basement would send it off to its destination in 15 seconds every time. By 1979, the information age was fully underway, and in order to remain cutting edge and relevant, the New York Stock Exchange had to innovate itself. From 1979 to 1981, on the floor of the exchange, over 15,000 pounds of cathode ray tube television and computer screens were installed, all supported by our superstructure. During the renovation, not a single day of trading was lost. All of the construction went on behind the scenes, and new trading posts were installed over the weekends. Innovations and advancements in technology such as this allowed the New York Stock Exchange to achieve a market cap of over $1 trillion by 1980. Handheld touchscreen computers have been used on the floor of the New York Stock Exchange since the mid-1990s. This Epson handheld computer from 1997 ran the card reader replacement tool, which allowed staff reporters on the floor of the New York Stock Exchange to report outcry trades on the tape. Advancements in technology and increases in computing power such as this facilitated the New York Stock Exchange to achieving our first 1 billion shares day on October 28, 1997. Brokers and designated market makers on the floor of the New York Stock Exchange utilize an advanced high-speed data network and state-of-the-art technology to execute over 1 billion shares a day. Our new integrated trading technology platform, NYSE Pillar, was completed in 2023 and allows member firms to connect to all NYSE equities and options markets. Pillar improves efficiency while reducing complexity, while enhancing consistency and performance for all of our customers. What will the future hold? We are excited to see what's coming over the next 200-odd years as technology marches forever onwards and upwards.
Chief Global Strategist at Freedom Capital Markets, Jay Woods, is joining me now. We talked a little bit about him earlier on in the show. Good morning, Jay.
Hey, good morning.
All good things, I promise.
Okay, all right, good.
So the market is getting ready to open up, but I mean, what do you think we can anticipate as we get ready for this?
Well, you said it's going to open up, and that's exactly what we're going to do. The futures are up a little bit. We're at all-time new highs. People, have been talking about all these negative things, but the S&P 500 closing another all-time high. Things are going slow and steady. This is fantastic. And we got some economic data to look forward to tomorrow, next week, but right now things slow and steady. It's not a bad thing.
Yeah, let's talk about those all-time highs. What do you think is driving the surge?
Well, right now we haven't raised rates. We've been flat for the last 7 to 8 months as far as the rates go, and we're anticipating maybe, just maybe, we're going to cut rates sometime before the end of this year, maybe 2 times. So what we're watching for is data in the unemployment numbers tomorrow that may stay flat or tick up a little bit, which means that the Fed's job as cooling this economy, lowering inflation, is slowly working. They're going to meet next Wednesday. They're going to get data on Wednesday in the CPI, and we'll find out if that's the case, and maybe, just maybe by September, we'll get that rate cut.
And we're looking out for tomorrow also. The May's jobs report is coming out. What are our investors pricing in at?
Yeah, well, they're looking for 3.9% unemployment. That is still historically low. It's ticked up off its low of 3.4% from about a year ago. If it ticks in 3.94%, that means the Fed is showing that the labor market is cooling slightly. We got that in the ADP number. We've gotten that in the JOLTS number on Tuesday. So we're seeing some softening in the labor market, and maybe this economy, which has been kind of stuck, is starting to see inflationary data tick down, and the Fed can cut that rate, and that would be fantastic for the overall equity market here.
And speaking of the inflation data and also like the Fed decision, we have new data coming out next week. What do you think investors should be on the lookout for, and what are you seeing right now on the trading floor?
Well, the CPI number comes out on Wednesday, and anyone down here can tell you that's the one number. When it comes out, it's getting a little rowdy down here before the opening bell. When that number comes out, we get more volatility around the CPI than any other number, and then you add that to the FOMC meeting and Jay Powell talking at 2:30 that afternoon, we could see some fireworks ahead of the 4th of July, a little early sometime next week.
Yeah. Speaking of the 4th of July, obviously summer months, what other big headlines right now are moving markets? We have about 40 seconds left.
40 seconds. We're seeing technology stocks continue to lead. AI continues to be the story. Software stocks have been lagging, but we continue to see the IPO market start to heat up. I think that will be the story as we come to the second half of the beginning of the third quarter, second half of the summer, as we finish off this year. I think you're gonna be very busy, Trinity, interviewing a lot of CEOs that come down here and list, because what better time to list than all-time highs and possibly lowering rates. So I think the second half and the end of the summer is going to be very exciting.
All right, now we have about 15 seconds before we get to the bell, but things are heating up. That's a good way to leave it, especially as summer's approaching, right?
Yeah, let's leave it as we're going to.
All right, wait, we gotta go. I'm Trinity Chavez. Thank you so much for watching.
Yeah.
iconic brands speak for themselves. The strongest brands stand the test of time.
We are so excited to welcome you to our community. Today is all about you.
We've never lost sight of what we're trying to do and deliver that mission.
Going through this experience with my partners and my families has been unbelievable.
We imagined something that didn't exist yet, and we believed that we could do it.
You're going to look back on this accomplishment as one of the finest you've ever done.
I want you to know that the best is yet to come.
Just a few minutes, we'll go downstairs to the legendary New York Stock Exchange trading floor to ring the opening bell. The history here, the tradition, it's just incredible for us to be at this moment.